Good evening. Welcome to Kenya News Update today. I'm your host, and we begin with a major story from the global automotive industry that has significant implications for international trade, manufacturing, and economic policy. The German luxury car maker, Mercedes-Benz, has just reported a staggering financial blow. Its full-year earnings have more than halved, plummeting by 57%, with the company directly attributing $1.2 billion in costs to international tariffs. This is a dramatic development for one of the world's most iconic brands, coming at a time of intense geopolitical friction and shifting trade winds. Tonight, we take a deep dive into what happened, why it matters far beyond Stuttgart, and what it signals for the future of global commerce. We'll examine the numbers, the political context, and the fierce debate between free trade advocates and protectionists. This is a 12-minute special report. Let's start with the hard numbers because they tell a shocking story. For the full year, Mercedes-Benz Group's profit fell to just over €1 billion. To put that in perspective, that's down from approximately €2.4 billion the previous year. That is a 57% collapse. The company's leadership pointed to three primary culprits: intense and brutal competition in the crucial Chinese market, unfavorable foreign exchange rates, and the headline figure, a massive $1.2 billion hit from what they term tariff costs. Shares in the company reacted immediately, trading down around 2% on the news. Chairman Ola Kalinius attempted to put a brave face on the results, stating, "Amid a dynamic market environment, our financial results remained within our guidance." But analysts are reading between the lines, seeing this as a clear warning siren for export-dependent European manufacturers. To understand the tariff costs, we must look at the current geopolitical landscape. Since January 20th, 2025, the administration of U.S. President Donald Trump has pursued an aggressively protectionist trade agenda, a hallmark of his first term now amplified in his second. A central pillar of this policy has been the imposition of sweeping tariffs on goods from key trading partners, including the European Union and China. For a company like Mercedes, which manufactures vehicles in Germany for export worldwide, these tariffs act as a direct tax on their sales in critical markets. A car leaving a factory in Sindelfingen bound for a dealership in Los Angeles or New York now faces a significant additional cost before it even reaches the customer. This erodes profit margins and makes their vehicles less competitive against domestic U.S. brands or manufacturers based in countries with more favorable trade terms. But the story isn't just about the United States. The tough competition in China note is equally critical. The Chinese automotive market, once a golden goose for premium foreign brands like Mercedes, BMW, and Audi, has undergone a radical transformation. Domestic electric vehicle makers like BYD, NIO, and Li Auto have surged in quality, technology, and consumer appeal. They are competing not just on price, but on innovation, often surpassing their European rivals in areas like battery tech and in-car software. Furthermore, Chinese government policies strongly favor these domestic champions. The result is a double squeeze for Mercedes. Its traditional profit sanctuary in China is under siege from local competitors, while its other major market, the U.S., is becoming more expensive and difficult to access due to policy decisions in Washington. Let's bring in our first perspective. We're joined virtually by Dr. Anja Schmidt, a senior fellow at the Berlin Institute for Economic Research. Dr. Schmidt, these numbers are stark. Is this a Mercedes-specific problem, or the canary in the coal mine for European industry? Dr. SCHMIDT, thank you. This is absolutely a bellwether event. Mercedes-Benz is not just any company. It is a symbol of German engineering excellence and export prowess. A 57% profit decline is catastrophic for them, but the underlying causes are systemic. The $1.2 billion tariff cost is a direct transfer of wealth from a European company to the U.S. Treasury, driven by political decisions. It undermines decades of carefully built supply chains and trade relationships. We are seeing similar pressures in the chemical, machinery, and pharmaceutical sectors. The model of made in Germany, sold to the world, is under existential threat from this new era of trade barriers. Companies are now faced with an impossible choice: absorb massive costs and see profits vanish, or attempt to relocate production, which is incredibly complex and costly for advanced manufacturing. Host, a dire assessment. Now, let's hear the other side of this debate. For that, we turn to Mark Thornton, a trade policy analyst with the America First Policy Institute in Washington, D.C. Mr. Thornton, The Trump administration's position is that these tariffs are necessary to protect American jobs and rebuild domestic manufacturing. From that viewpoint, isn't Merced's profit drop an expected, even intended consequence? Thornton, absolutely. President Trump has been clear since his first campaign: the era of the United States getting taken advantage of in trade deals is over. For decades, American automakers and auto workers faced an uneven playing field. European tariffs on U.S. cars have historically been higher than U.S. tariffs on European cars. The president's policies are designed to correct that imbalance and force reciprocity. If a company like Mercedes wants the privilege of selling to the American consumer, the world's most valuable market, then they should face the same terms American companies face abroad. Furthermore, this policy is working. We are seeing a renaissance in U.S. manufacturing investment. The goal is to have more cars built in Ohio, Michigan, and Alabama by American workers, not in Germany. If that means a temporary adjustment for foreign corporations, that is a price worth paying for long-term national economic security. Host, two fundamentally opposed views. Dr. Schmidt, how do you respond to the argument that this is simply creating a level playing field? Dr. Schmidt, it creates a level playing field only by lowering everyone to the ground through a trade war. This isn't negotiation, it is economic conflict. The data shows that tariffs are largely paid by importers and consumers, in this case, Mercedes and then potentially American car buyers. They do not automatically translate into more U.S. factory jobs. Instead, they trigger retaliation. The EU has already announced counter tariffs on American goods, from bourbon to agricultural products. This tit-for-tat escalation hurts businesses and consumers on both sides of the Atlantic. It's a negative-sum game. The solution is modernizing trade agreements, not demolishing them. Host, let's visualize the scale of this impact. The $1.2 billion tariff cost cited by Mercedes is not an abstract figure. To comprehend it, consider that it represents a sum larger than the annual budgets of several major government ministries here in Kenya. It is money that is not being reinvested in research for the next generation of electric vehicles, not being paid out to shareholders, and not being used to bolster the pensions of its German workforce. It is essentially a penalty fee for engaging in international trade under the current rules. This single line item is responsible for a significant portion of that 57% profit decline. Beyond the immediate financials, this report signals a strategic crisis for Mercedes. The company has staked its future on an electric transition, with ambitious goals to go all electric by the end of the decade, where market conditions allow. This plan requires enormous capital investment. A halving of profits severely constrains their ability to fund that transition. They are caught in a pincer movement, needing to spend billions on EVs to compete with Tesla and Chinese rivals, while simultaneously seeing their traditional cash cow, luxury internal combustion engine cars sold in the US and China, come under severe margin pressure from tariffs and competition. This could force painful delays or a dilution of their electric ambitions. There's also a potential knock-on effect for Kenya and the broader African continent. As global manufacturers reassess their supply chains due to trade tensions, Africa presents an opportunity as a potential manufacturing hub to serve multiple regions. However, uncertainty and the threat of arbitrary tariffs can scare away the very investment needed. Furthermore, for the growing elite and middle class in nations like Kenya, who aspire to own premium brands like Mercedes, the increased costs from tariffs could eventually trickle down, making these luxury goods even more exclusive and out of reach. Returning to our debate, Mr. Thornton, critics argue that this approach risks fracturing the global economy into blocks. Are we heading towards a world where companies must choose between producing for the US market or the EU market, but not both efficiently? Thornton, we're heading towards a world of fair and balanced trade, something that has been lacking. If the choice is between that and the continued offshoring of American industry, then yes, that is the direction. Companies are adaptable. We're already seeing European and Asian automakers announcing new plants and expansions in the United States. That's a win for American workers. It's not about fracturing the world, it's about ensuring every nation has a strong industrial base. Resilience is more important than efficiency if that efficiency is built on dependency. The pandemic and recent global tensions have shown the dangers of over-reliance on complex, far-flung supply chains. Host, Dr. Schmidt, your final word. What is the end game here if this tariff war continues? Dr. Schmidt, stagnation and lower growth for everyone. We have historical precedent. The The Smoot-Hawley tariffs of the 1930s deepened the Great Depression. While we are not there yet, the principles are the same. When trade flows shrink, everyone becomes poorer. The end game is a less prosperous, more insular, and more conflict-prone world. The solution lies at the negotiating table with the World Trade Organization, not in unilateral declarations of economic war. The $1.2 billion loss for Mercedes is just the first, very visible casualty. Host, Dr. Anya Schmidt and Mark Thornton, thank you both for that vigorous debate. As we conclude, the Mercedes earnings report is more than a corporate financial statement. It is a high-resolution snapshot of a global economy at a crossroads. It captures the clash between globalization and economic nationalism, between integrated supply chains and the push for sovereign resilience. The 57% profit drop is a number that will resonate in boardrooms from Wolfsburg to Detroit to Tokyo, forcing a recalculation of decades-old business models. For consumers, investors, and policymakers worldwide, it serves as a stark indicator that the rules of international commerce are being rewritten in real time, with significant costs and consequences. The road ahead for iconic brands, and for the global economy itself, appears fraught with new obstacles. For Kenya News Update Today, I'm your host. Subscribe to Kenya News Update Today.